The Japanese bond market more recently has become a problem. And this has been festering for a very long time. We obviously saw some issues with the carry trade in the yen last year. So we saw that blip sort of play out for a few days, maybe a week. And we're sort of getting potentially Mark II of that again now with regard to Japanese bond yields. So more recently, you had a Japanese inflation print, which was much higher than expected, which pushes the central bank there to consider raising rates more aggressively. Japan has had rates at zero and or negative for a long, long time. More recently, they've been incrementally raising rates a couple of times and needing to raise more, but have been holding back. Inflation has now spoken, and you've got Japanese bond yields rising fairly aggressively. And so some might say, so what? What's the problem with yields being higher? It's attractive to savers, that sort of thing. There's a couple of big issues to note here. One would be the fact that if you're a Japanese saver, you've been starved of interest for a long time. So what you've done to mitigate that is you've parked money offshore. So you don't park your money in Japan, you send money everywhere and elsewhere. So Australian bonds, Australian cash, US bonds, US cash. If you've got homegrown government bond yields now at 2s, 3s or 4s, you're going to bring the money back. There's no point having it offshore where the currency risk. So there's definitely a risk of that money coming back. So that's a risk to other markets, not necessarily the Japanese market.